Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're going to be taking a look at Fair Isaac Corporation, ticker FICO, FICO. You might know them from your FICO score if you ever go to try to get a loan or credit for anything. This one came in by request down in the comments section of one of my other videos. If you have a request, just put it down in the comments. I'll get the ticker on the whiteboard behind me. Eventually I'll make a video. If it's a stock that's in S&P 500 like FICO is, I post those on YouTube for free. If it's a stock that's not in the S&P 500, I post those on Patreon and in the full Cyclical Investors Club service. Patreon's $5 a month if you want to just get those extra requests that are not in the S&P 500. And then if you join there and you ever decide to join the full Cyclical Investors Club service on Seeking Alpha, you get a big discount. So I have all those links down in the description. I also have a link for Fast Graphs, which I'm going to use in this video. And it's a 25% off affiliate link, and they have free trials and stuff there too. So you can give it a try, see if you like it. And if you haven't used Fast Graphs before, then you get that discount if you use the link. All right, as always, this is not individual investment advice. This is just how I analyze stocks. So Fair Isaac is an interesting one to look at. Partly because its earnings have been pretty steady. They had a little bit of a decline, as you might expect, during the Great Recession. This dark green shaded area in the fast graph is earnings per share. So actually, yeah, like starting about the peak of the housing boom, through the Great Recession, they kind of had, a steady decline. And then ever since then, basically, though, earnings have been rising. So let's shorten this down. I like to take, after we take a peek at it, we can see earnings aren't super cyclical, so we can use those to estimate the value of the stock. My valuation is not going to include a downturn. So that's worth pointing out because we saw, just looking at the Great Recession, that FICO's earnings have a history of falling a little bit, like a decent amount. I would say about the same as an average business during a real recession, right? But if we're not in recession, they've been growing earnings really well. They have been buying back shares. I forgot to double check to refresh how many they've been buying back. So that will inflate this earnings per share number a little bit. But since there's no drawdowns or anything, this is a pretty straightforward one in some respects to analyze. I'm going to shorten this just to see what the fast graph growth rate is. So during this period from 2016 to 2024, earnings per share grew at 26% per year. But I think it's worth zooming out a little bit. And we always have to ask ourselves, how sustainable is this? And then also in the back of our mind, we want to think, how much could these fall during a downturn, right? So we looked back here, if we did the growth rate from during this period, and this isn't a short period really, 1, 2, 3, 4, this is 5 years, right? 1, 2, 3, 4, 5. Earnings fell 7.44% per year, okay? So we know that there can be periods where earnings can fall and have significantly slower or negative growth. And when you include these into like an earnings growth estimate, which is what we're trying to do here, so let's just expand this out and get more of like a full cycle. Let's even go to we'll go we had tax cuts in 2018 or 2019. Yeah, this looks about right here. So we'll call this like a full cycle from peak to another peak here before we started getting a bunch of tax cuts and stimulus money and pandemic and all that stuff, right? So you could kind of call this kind of a full cycle. The earnings growth during that, the average earnings growth rate was 6% a year during that time. I actually like to include these downturns into like how many cumulative earnings could you collect. So the growth rate would be even lower if you do it that way, which is how I tend to do it. So I just want to point out, because we're going to have to make some estimates here about what we think future earnings growth is going to be. And lately it's been on fire, right? But it's important to go back and look at what could happen. So you understand that it's not a guarantee. This 26% growth rate is not a guarantee, and I would say it's almost impossible to continue it for 10 more years, right? Which is what I'm going to use when I try to do my valuation. So I'm saying, okay, if you bought this business here and you owned it for 10 years, how much money could you make? That's basically what I'm asking when I do these valuations, especially a pretty straightforward one like this. So when I looked at FICO and I thought about it, this is a business that's currently over a $40 billion business, right? Do we think a $40 billion business can grow at 20% for 10 more years? Or 26, if we just want to take this, like 26% for every year for 10 more years? Probably not, right? The total addressable market, unless they tap some other huge market, which sometimes companies do, but it's not something I would like bet on. It is interesting that their credit rating is only double B plus when their credit rating place. But anyway, side note. So I think with this one, what I do, usually I look at the history and I say, okay, and I would cap this at like 20%, right? So a person could do that. And that puts some reasonable expectation on the future. But I'm skeptical that like 20% growth for the next 10 years they can actually do. So for me, I decided to go with 15%, which is still, that's 15% per year per 10 years is what I'm looking at. And so that's kind of my reasoning behind it. It's just an estimate. It's not taken directly from history. Maybe if I took the longer term history, I actually didn't think about this to get like a full perspective. So I'm just going to go from like this year back to 2004 and see what oh, look, 13.83%, right? So that's a little less than the 15 that I was talking about, and they bought back some shares during this, so it's actually probably a little bit lower. So to me, now obviously this business has changed a little bit over the years for sure, but the point I'm trying to make here is I think 15% a year assumption is plenty generous when we're trying to estimate what the future earnings growth might be, okay? So that's my thoughts behind coming up with my earnings growth estimate. Now, the next thing we need to look at, once we have an earnings growth estimate we feel comfortable with, is what is the current like PE ratio or earnings yield. So the current PE on this stock is 76, which is pretty incredible to me, like a little nuts actually. Especially when you consider that how much has really changed in the past 2 years when it traded at a 23 PE, which seems pretty reasonable to me. Like that seems like fair value probably. How much has the stock gone up? 300, probably close to 350%. That said 335, but that might not have been the bot. Like you probably could have gone there and gotten even cheaper. So the question is, what is so great now that wasn't great 2 years ago, you know? And I don't know, I didn't look to see what the stories people are telling, but earnings have not, remember now earnings could have grown that much in theory, and that would have justified the higher PE, but they haven't. They actually grew slower these 2 years than they did the previous 4 years, right? So earnings growth is actually slowing down. So just on the surface, this valuation looks a little ludicrous to me. Unless there's like a buyout on the table, offer on the table or something, which I don't think there is. I'm sure I would have seen that headline. But we can actually run the numbers and see what this actually looks like. So I'm assuming a 15% growth rate. This is their 3-year cumulative revenue growth. So you can think this is sometimes useful to look at too, in case we're just missing something with the earnings, like they're actually growing the top line a lot. That's pretty good. I mean, that's not 15% a year, right? I mean, if you just did like a little quick math and divided it by 3, by the 3 years, you're looking at like 7%, right? So a year of revenue growth. So 7% revenue growth, a 70 PE, right? And I'm going to assume a 15% earnings growth rate. So the way this works is, and I don't think I didn't adjust the stock price very much for their for whatever debt they have, because the difference between their total enterprise value, which is 45 billion, and their market cap, which is 43, is they're pretty close. So I just have a small adjustment for that. And so basically my PE, and this would be forward looking, I actually, since this was so overvalued, I thought, well, let me give everybody like the benefit of the doubt. Let's give the market the benefit of the doubt here. Maybe they see something coming that's awesome that we don't. So I actually went forward a year, which their year's almost over. They just have to report one more quarter. But so I'm actually going to pull forward this 29.45 for my earnings. And that gives a lower PE ratio of like 59 right now. So instead of 74. So I'm trying to be as generous as possible here, because I know that it looks overvalued, and I want to say, okay, let's give the market some credit and let's see where that ends up. So when we do that gives us a PE of, sorry, not a PE, but an earnings yield, which is the inverse of the PE, the earnings over the price. Basically the same thing, of 1.56%. So the way to think about this is if you bought this whole business for $100, right now it would earn, and you owned it, and you could just keep the earnings, you would earn $1.56 on your $100 investment. And then what I do is I assume that will grow, that $1.56 on a $100 investment will grow at 15% a year. What I want to know is how much money I could collect on my $100 after 10 years, right? So that's what this spreadsheet's set up to decide. I go to the 10-year mark, which is right here. So your $100 using these assumptions growing at 15%. Remember, the $100 part doesn't grow at 15%. The earnings of on that 100. So it's the $1.56 that grows at 15%. Sometimes people ask me about that. You would end up with a $136 after 10 years, right? So what's the CAGR on that? CAGR on that is 3%. It's like the inflation rate, basically. Well below, what cash yields right now. Now that cash might not yield that for 10%. I think it is below 10-year treasury bonds too still. So this does not look very appealing to me. Like if it's under 5%, that's pretty much too low. I would think about taking profits in the stock if I owned it based on valuation. So when you get to the buy prices, they get a little nuts. So I want this to be 8% before I buy normally. And the price would have to fall to about $300. So it needs to fall about 80% before I'd actually consider buying it. Fair value would obviously be higher than that. Let's see, just to show I'm not totally nuts. 2 years ago, it traded at $350. Okay? So, and it was probably, they've earned more money, and I'm counting these earnings, so it wasn't quite as nicely valued at that point. But it would, like just glancing at it, this looks like fair value right in here to me. And so the point I'm trying to make is if you're looking for a margin of safety, that's not a totally nuts number. Now, if you go back to the Great Recession, which is what this buy price is based on, it would be even more than that. It'd be like 90%. This is the most expensive stock that I track right now that I have an actual buy price on. So out of maybe 350 stocks that I have buy prices on, this is the most expensive one. I shouldn't say it's the most expensive one. It's the one that's the farthest away from the buy price. Not even using the recession PE. So yeah, if I owned it, I would be looking to take profits. If I was looking to buy it, that's basically where I'm looking at. And then fair value, I can test some here and let's just see. So if I had to guess, fair value would be like 8% is the threshold that I used to buy. 4% is about the threshold, or under 5 is about the threshold to sell. 6.5% is about what I would call fair value. So let's see what price we would have to pay to get there. I'm going to say maybe $550. I'm just going to guess. Oh no, it would almost be a... Wait a second. I might have done this. I might not have the right numbers in. So let's just check. Yeah. I must have been... Oh, I know what I did. I was looking cheaper. So the buy price is not correct. This is almost 8%. So if we go 545, I'm glad I checked this. There we go. That's 799. So yeah, this should actually be 545. Actually, there we go. So 545 would be the buy price. This recession price still stands. I actually only had the recession price in until right before I made the video, and then I just quickly did some numbers. I was probably looking at 12% here instead of 8%. I was thinking of more of a fast growth stock. That's what I use for those. So that's where that other number came up for. So I apologize for that. 545 would be based on earnings, where this would cross 8%. So we would need it. That would be a little bit higher if we were aiming for like 6.5, right? So maybe like 700. That's just about it. Like a little over 700. Maybe 720. There we go. So 720 for fair value, 540 if there's no recession and you want a margin of safety. If we're going down in a recession and things are falling off a cliff, then we're using the recession price that's like 90% lower. So that should be correct. If you have any questions, let me know. Like I said, this one's so far away from being a buy, I haven't really paid too much attention to it. I just occasionally go update it, and I quickly updated a couple of the numbers before this video. One other thing I will show you is, let's just look at what the so this normal PE, often people ask me about why I don't use this. This is actually a stock it might be useful to use it for. Let's use this time frame, but let's extend out 1 year here. So what this is the average PE ratio during this time. So you get an idea, look, what has the market normally been willing to pay? So normally the market has been willing to pay a 37 PE for the stock. That's pretty high, but it has a lot of growth, so that makes sense. So that's pretty generous, I think. If it were to, and what you can do here is, and you can kind of see how it was undervalued during this period, right? And so using this normal PE, it would have came in handy. It works good sometimes with these steady earners. But you can see that right now, if you use the normal PE, now it depends on how fast it adjusts to the normal PE. But if it just did it really quickly, you would lose 50%, okay? And that price is like 870. So if it did it over the course of a year, you'd lose 37%. This is assuming earnings growth meets these earnings growth expectations. And over the course of 2 years, you lose 25%. So this is why it's kind of dangerous to pay this much money. Now, maybe they surprise on earnings and they are fantastic. I had that happen with Palo Alto. You know, it really surprised, like earnings were 50% higher than expected. But that's kind of the danger of paying too much for a stock. Whereas if you bought down here when it was below this average PE, and let's say you just went to this date and it only did average, like it just went back to where the market kind of likes to normally pay for it, you still would have made 150%, right? Now it might not have been, the average might not have been that high in 2022. You can adjust the graph and look at it. So average over that, it's just a little less, like 36. So it's about the same. But yeah, these are the ones I just kind of look at and I say, oh, they're really overvalued, and I just ignore them. Now, an example, I'm going to go ahead and make this a longer video. An example of a stock that did this before that I actually owned. I bought this one during the pandemic here, and I took profits like somewhere in here, and then it just rocketed up like this. Not all that dissimilar from FICO, and because you can see what's the PE. The PE is almost exactly the same, right? 75, and a good long-term history of earnings growth too. It doesn't look quite as fancy, as quite as perfect as FICO's, but that's really a good long-term graph. They got kind of jumbled up because of the pandemic, so they had a rough year and then they made up for it like the next year, and the market basically only was looking at 1 quarter at a time, and so it ends up with this 75% valuation situation. So if you went back and in the heat of the moment. Let's see. Now I did not take profits near the top of this, but it's lower than and I made 100% on it in like 6 months or something. But at the time, this is what you would have been looking at here. Let's turn the blue line off for a second. Just kind of clutters things up. So you're at the same valuation, up in the 70s, right? Earnings growth grew 100% in that year. And the market's all like, yeah, this is wonderful. But it really just takes a little bit of slowing of earnings. They had this year, which basically just reverted to normal. And now they've continued on with their typical growth rate, again, in this low teens area. But if you wouldn't have taken profits up here or at some point along this way, you lose 65%, right? And you never know when that's going to happen. And there are some stocks where it seems to never happen, like Costco. So you can kind of get a view on. So this looks a lot like FICO, right? And it's not quite as high as FICO. The PE isn't, but it's a much more intensive business and complicated business than FICO. So, but nevertheless, these stocks can stay overvalued for a long time. It was only at a 30 PE here. I thought it was overvalued back here when it was like a 35 PE, but sometimes the market can go years and, that's a 200% return that I would have probably missed out on if I sold. I didn't own this one, but if I did, I could totally see myself taking profits back here. But based on earnings, they haven't really, I don't know what their earnings growth is. Let's just look at it real quick while I'm at it. So we'll assume they hit all that. 12%, 13%, right? They're good, but they're not 55 PE good. So that's another one that's like really overvalued, and so far it's not showing any signs of coming down, but eventually the higher they go, the riskier they get, I guess is what I would say. So that's how I would look at FICO. All right, thanks for asking for this one. If you have a request, put it down in the comment section and I'll get it on my list. And I have a free tier over on Patreon too, if anybody wants to check that out. I post all the same YouTube videos there, and then I post some extras too. When I get time, hopefully this winter I'll have some more time for some extra kind of Patreon only stuff. Been a little busy this summer. All right, I'll see everybody later.